Good day and welcome to SCO BRICS Insight, where we talk about what's really going on in the world of the BRICS. My name is Rod Mackenzie, and today I want to talk about Trump's tariff wars that have caused havoc with the oil prices, with the current oil price below $70 per barrel. And this has caused the US shale companies to start shutting down drilling rigs and cutting back on production, because the current global oil price are rendering them completely unprofitable. Now, it also appears that the period of significant growth in the US shale industry is drawing to a close. Plus, analysts are confident that the US may not witness the same level of production growth as they witnessed a decade ago. The period of significant growth is now ending, despite promises by Donald Trump to speed up production and drill, baby, drill. Oil and gas companies are now shutting down drilling rigs and they're cutting their costs. The Financial Times reports that lower oil prices have had a negative impact on profits. Estimates of some shale producers' profitability does vary. A quarterly survey conducted by the Federal Reserve Bank of Dallas indicates that the US shale companies require a minimum pricing of at least $65 to $70 barrels just to reach their break-even point. So recently the US West Texas Intermediate crude price has slipped below $62 per barrel, and that's a problem. According to Rystad Energy, the break-even point for production in fully undeveloped shale fields is the $60 per barrel. For comparison, the same figure for easy-to-extract fields in the Middle East is $27 per barrel, and in Russia it's around $35, according to Sergei Tereshkin, the CEO of Open Market Oil. Now, the cost of production in the US varies significantly for different shale projects, with costs ranging from high to low. However, it's important to recognise that the initial cost of extracting shale hydrocarbons is substantial. Now, the decision by Americans to commence shale oil and shale gas production was not driven by prevailing economic conditions. In the 1970s, it became apparent that the conventional oil deposits and gas deposits in the US were depleting, prompting the introduction of incentives for new developments to ensure consistent production levels. Now, before I continue, I'd like to make an appeal. If you like and enjoy my videos, you can help me fund the channel and my website, SCOBRICSInsight.com, and you can do this by making a small donation, which is done by clicking on the thanks button at the bottom of the video screen. Every donation does get a personal thank you from me, and I'm thanking you all now. Now, also set the alert button so that you get notified when I post a new video, and also keep the comments coming. I do love to read and respond to the comments. So many of them are very interesting and very well put together. Now, however, it was not until the 2000s that the strategy gained traction, coinciding with the shale revolution. Then they were able to combine the technologies that were already known to the industry, enabling the profitable production of shale gas. However, if the US had abundant classic deposits with low cost, then the shale projects wouldn't have been considered, according to Igor Yushkov, who's an analyst at the Russian Financial University and a member of the National Energy Security Fund. He said, initially the focus was exclusively on gas production, with the subsequent development of light sweet gas condensate, now known as shale oil, occurring in a subsequent phase. Another factor that has driven the shale revolution is the high gas prices. If gas prices in the US hadn't been so high at the beginning of the 2000s, then the shale revolution might not have happened. Whilst there's been significant progress in production technology, the extraction of oil still remains a costly process. Consequently, when the price of oil falls below $70 per barrel, statistics immediately show a decrease in the number of drilling rigs in the United States. Production levels are currently below the record levels achieved back in 2022, 2023. Now, according to Statista, the number of rotary drilling rigs for crude oil and natural gas production in the United States in 2022 was 723 units, and in 2023 it was down to 687 units. In February 2024, only 590 units were in operation, and the number continues to drop as the price of oil drops. Now, if we go back a decade, we can see that the decline in shale hydrocarbon production looks even more significant. In 2012, for example, the United States had almost 2,000 drilling rigs in operation, and that's 4 times the current figure. Now, according to Yushkov, the most profitable fields in the shale formations, with the lower production costs and higher profits, have now been depleted. They were drilled first, especially during the crisis period of the falling prices back in 2015 and 2020. Now, it's logical that the US there remains only areas with more complex wells in terms of geology and economics, and the work on those is obviously more expensive. Now, the continued decline in shale hydrocarbon production is contingent on global market conditions. Should oil prices rise to between $80 and $85 per barrel, then we can expect to see an increase in American production. Conversely, should prices fall or further, or actually just still remain at this low level, then we'd expect to see a continued decline in production. I mean, the volume of production in the US is determined solely by economic factors. Now, that's in contrast to the price of oil on the global market, which is influenced by numerous factors, including US foreign policy. I mean, for example, if the US were to impose more stringent sanctions on Russia or Iran, potentially leading to a reduction in their ability to export their oil to world markets, then there's a possibility of rising prices. Of course, that would then lead to American projects becoming more profitable, and the US companies would resume drilling and the production of oil. However, it should be noted that there'll be no longer exponential growth in shale oil production, as was the case 10 years ago. I mean, the period of rapid growth in the US is definitely over, according to Yushkov. He explains that new fields will have to appear in development, and they won't replace the lost volumes of the old depleted fields. Now, the significance of the shale boom for the US economy has been considerable. I mean, firstly, the growth of shale gas led to some of the lowest prices for this commodity in the world, and particularly on the US domestic market. I mean, recently the price of 1,000 cubic meters of gas in the US went up from $100 to $150, and that's not surprising that the US is able to attract plants from the US where gas prices are several times higher than that. I mean, a welcome byproduct of this process was the production of gas condensate. Now, that gas condensate is now normally referred to as shale oil. I mean, the US primarily exports this light oil while importing heavy sulfurous oil from Canada and Mexico, as it used to do from Venezuela and Russia, as it's technically better suited for making gasoline and diesel, which is used in American refineries. However, the US has successfully reduced its oil imports. In the mid-2000s, oil imports to the US exceeded 10 million barrels per day, but by 2024 that's now down to 6.6 million. At the same time, oil exports from the US went from 590,000 barrels in 2016 to 4.1 million barrels per day in 2024. Now, the shale revolution's had a significant and positive impact on the American economy. I mean, it's contributed significantly to its increased GDP growth, it's strengthened the labour market, and improved the trade balance through higher exports. Plus, the US's own oil industry has reduced its reliance on foreign suppliers, such as Saudi Arabia. I mean, the political consequences of the shale revolution have enabled the US to enhance its independence from the Middle East and to pursue a slightly freer economic policy in the region. I mean, prior to the shale revolution, the US relied on oil from the Middle East, including Saudi Arabia, the United Arab Emirates, and Iraq. I mean, that Saudi Arabia was always dependent on the US for political and economic support, and Saudi Arabia was also a key supplier of oil to the US. So the US had a strong interest in maintaining stability in the Middle East. Conflicts in the region, which could potentially disrupt the oil supplies to the US, were a major significant concern. So they were obviously all over it like a rash. I mean, it's important to note that now the majority of Saudi Arabia's oil exports now go to China, which obviously is the United States' main geopolitical rival on the world stage. And the US is no longer a guarantor of security for Saudi Arabia. So you've got, what measures could the US do to impact on China as regards oil? Well, the US thinks it has the capacity to restrict China's access to oil from Russia and Saudi Arabia, and it might even attempt to do so. I mean, if it were to seek to destabilize Saudi Arabia, though, it would be in China's interest to reduce their imports of Saudi oil rather than the US's own interest, as it has been the case in previous years. Anyway, if they did that, they would drive up the price of oil, which would then help their drillers. But it would then hurt their own economy by increasing gasoline prices. So it's between a rock and a hard place. You're never quite sure what Trump's going to do. Anyway, thanks for watching. Please like, share and subscribe. Do set the alert button so you get informed when I post a new video. And if you want to help me out, click on the thanks button at the bottom of the screen and make a donation. Thank you, and I'll see you all again soon. Thanks.